This chapter 2 describes the methodology behind S&P's determination of the economic risk component of its so-called BICRA. BICRA stands for Banking Industry Country Risk Assessment, a methodology designed to evaluate and compare global banking systems. S&P's approach to the determination of a banking system's BICRA score can be found in its publication titled Banking Industry Country Risk Assessment Methodology and Assumptions, dated November 9, 2011, a link to which again can be found in the course outline. A BICRA is scored on a scale from 1 to 10. 1 representing the lowest risk banking systems, and 10 those with the highest risk. The BICRA methodology has two main analytical components: economic risk and industry risk. We deal with economic risk in this chapter and with industry risk in chapter 3. The table appearing now lists the factors and subfactors that determine the economic risk score under BICRA. The three factors S&P considers are economic resilience, economic imbalances, and credit risk in the economy. Under economic resilience, the three subfactors listed are economic structure and stability, macroeconomic policy flexibility, and political risk. Under economic imbalances, S&P distinguishes first between economies that are undergoing an expansionary phase and those which are in a correction phase. For the former, 4 subfactors are listed: private sector credit growth, residential real estate prices, equity prices, and the current account balance and external debt position. For the latter, i.e. for economies in a correction phase, only a single subfactor is listed, namely the expected impact on the banking sector. Under credit risk in the economy, the 4 subfactors listed are private sector debt capacity and leverage, lending and underwriting standards, payment culture and rule of law, and sovereign government credit stress. S&P also lists a number of additional adjustments in the column on the right, each of which will be discussed when we analyze the factor to which it relates. Each factor listed above is scored on a numerical scale that ranges from 1 for very low risk to 6 for extremely high risk, based on an analysis of the characteristics associated with each factor and its subfactors. The overall assessment of economic risk is determined by the number of points assigned to each risk score, as shown in the table appearing now. Whereas you can see the first 3 categories are assigned points equal to their risk score, while the remaining 3 categories are penalized in a gradually increasing manner. The point total for the economic risk score is then converted back into a unique score on a 10-point scale, with 1 again representing the lowest risk and 10 representing the highest risk. This is done in accordance with the table appearing now, which once again does not adopt a linear approach, as you can see, since a total of 5 points, for example, converts into a final economic risk score of 2, while triple that number of total points, or 15, converts into a final economic risk of 7. We will see later that the economic score is combined with the so-called industry score to determine the BICRA group in which the banking system in question falls. Our next step, however, is to comment in greater detail on each of the subfactors we listed above. Within the factor economic resilience, the first subfactor is economic structure and stability. This leverages S&P's methodology for sovereign credit ratings, which is too long to describe in detail here, but which we summarize very briefly in a few sentences. S&P determines for each rated sovereign an assessment for 5 principal rating factors, namely institutional effectiveness and political risks, referred to in short as the political score, economic structure and growth prospects, the economic score, external liquidity and international investment position, the external score, fiscal flexibility and fiscal performance combined with debt burden, the fiscal score, and finally monetary flexibility, the monetary score. As with the factors under BICRA, these receive a score ranging from 1 for strongest to 6 for weakest. These are ultimately combined with other considerations to produce an overall domestic and external credit rating for the sovereign. A separate module in our library discusses in detail the methodology of the credit rating agencies for sovereign ratings. But suffice it for now to say that each of the 5-factor assessments produced in the course of the S&P sovereign rating process becomes an input in the BICRA process, as we will see shortly. The first of the sovereign rating factors we listed a minute ago was the so-called economic score, which becomes the country's economic resilience risk score for purposes of the BICRA methodology. In turn, this may be adjusted upward or downward by 1 notch if GDP per capita in US dollars is not considered to reflect adequately the country's economic structure or stability. Examples of cases where data could understate the real risk to the banking sector are oil-producing or high-inflation economies. Oil production may result in significantly higher GDP per capita, leading to a lower initial economic resilience score than what the country's actual risks to the underlying economic structure and stability would represent for the banking sector. In such cases, the result typically is a 1-notch adverse adjustment in the score for this factor. In a similar manner, high inflation hurts a banking sector, so S&P makes a 1-notch adverse adjustment to the initial economic resilience score for high inflation countries. The next subfactor is the degree of macroeconomic policy flexibility. Again, S&P begins by extracting from its sovereign methodology the sovereign's fiscal and monetary scores, and proceeds to make a one-notch adverse adjustment to the initial economic resilience score if both of the following apply. The average of the fiscal and monetary scores from the sovereign analysis is higher than 3.0, and the difference between the average of the fiscal and monetary scores and the initial economic score is equal to or greater than 1.5. For example, a country with an initial economic score of 2, but whose fiscal and monetary scores average 3.5, would be assessed an economic resilience score of 3, which is worse by one category as required by the immediately preceding rule. The last subfactor under economic resilience, namely political risk, is treated in a similar manner. In the case of countries whose sovereign political score is 2 or more categories weaker than the initial economic resilience assessment, S&P makes a one-notch adverse adjustment to the economic resilience score. Illustratively, S&P assesses the United States at very low risk on account of economic resilience, acknowledging the country's competitive and diverse economy, high GDP per capita, long track record of not restricting capital flows, strong track record of prudent and credible monetary policy that ranks among the best in the world, exceptionally flexible labor and capital markets, resistance to adverse economic developments such as external shocks, and the effectiveness, stability, and predictability of political institutions and policy making despite some recent deterioration. Weaknesses identified under this factor include the steadily deteriorating fiscal profile during the past decade, decaying political dynamics, which imply risks to progress towards a medium-term fiscal consolidation plan, and an aging population and long-term trends in healthcare inflation, which appear likely to force higher government spending on Social Security and Medicare. Links to S&P's report on the US BICRA can be found in the course outline, as usual, that you can access by clicking on the icon at the bottom left of this video, but you will need a paid subscription to access the full version of these reports. We turn next to Factor 2, Economic Imbalances, in which, you may recall, S&P distinguishes between expansionary and correction phases. For expansionary phases, the assessment of the economic imbalance score is initially determined by means of the matrix appearing shortly, which uses as inputs the change in domestic credit to the private sector as a percentage of GDP and the average annual change over 4 years in inflation-adjusted residential housing prices. The matrix appears now, where you can see that the various combinations give rise to scores as low as 1 or as high as 6, with 6 applying in the case of economies that have experienced especially pronounced private sector credit growth and inflation-adjusted housing price increases in recent years. Starting from this initial score, a number of adjustments are made, as with the economic resilience score, but never to exceed a maximum of 3 notches. First, the score is adjusted by 1 notch up or down if either the change in private sector credit growth or in asset prices is not an adequate reflection of economic imbalances, such as, for example, in the case of a country which is an international financial center like Hong Kong, which may show significantly higher credit growth than what is actually being channeled into the domestic economy. Second, for countries where commercial real estate prices are available, S&P examines the average annual change in inflation-adjusted commercial real estate prices over a 4-year rolling average, along with vacancy rates as a percentage of total commercial real estate units. A 1-notch adverse adjustment to the score is applied if S&P concludes that the commercial real estate segment represents a higher risk than the residential real estate segment. A further 1-notch adverse adjustment is applied to those banking sectors with substantial exposure to the stock market if the average annual rise in inflation-adjusted equity prices over the 2 most recent years has been greater than 40%. Finally, S&P reverts once again to its sovereign ratings methodology and extracts the country's external risk score, which it uses in BICRA to assess the last subfactor under economic imbalances, namely the banking sector's vulnerability to the current account balance and the external debt position. The table appearing now reveals 3 categories for the assessment of this subfactor, with limited vulnerability corresponding to a sovereign external score of 1, 2, or 3, leaving the initial economic imbalance score unchanged. Moderate vulnerability corresponding to a sovereign external score of 4 or 5, giving rise to a 1-notch adverse adjustment to the initial economic imbalance score, and significant vulnerability corresponding to a sovereign external score of 6, giving rise to a 2-notch adverse adjustment to the initial economic imbalance score. We turn to economies that are experiencing a correction phase, for which an entirely different approach applies to the determination of the economic imbalance score. Evidence of the start of a correction phase is seen through growing or elevated credit losses on a banking sector's balance sheet. The impact of this correction may last for 2 to 3 years and may be quote unquote limited, high, very high, or extremely high, according to S&P. The table appearing now describes how these 4 descriptions are applied, based on what initiated the correction phase and the remaining impact it is expected to have on the banking sector. Thus, the phase is deemed likely to have a limited impact, earning an initial risk score of 3 if an asset price or credit bubble has burst in the last 3 to 5 years, the correction phase is nearing the end, and the projected remaining impact on the banking sector over the coming 2 to 3 year period is limited. The phase is deemed to have a high impact, earning an initial risk score of 4 if an asset price or credit bubble burst, or a current account crisis started 3 to 5 years ago. The correction phase is ongoing, and the projected impact on the banking sector over the coming 2 to 3 year period will be high. The phase is deemed likely to have a very high impact, earning an initial risk score of 5 if an asset price or credit bubble burst, or the country is experiencing a current account crisis. The correction is ongoing, and the projected impact on the banking sector over the coming 2 to 3 year period will be very high. And finally, the phase is deemed likely to have an extremely high impact, earning an initial risk score of 6 if an asset price or credit bubble burst, or the country is experiencing a current account crisis. The correction phase is ongoing, and the projected impact on the banking sector over the coming 2 to 3 year period will be extremely high. S&P identifies the Danish banking sector, whose loan loss ratio peaked at 1% in 2009 and is trending to below 50 basis points, as qualifying for the limited impact designation. The housing market in Spain in 2011 as one that is expected to have a high impact on the banking sector. The US housing market in 2008 as having had a very high impact on the banking sector. And the Latvian housing market in 2008 as having had an extremely high impact, with prices correcting by 50% or so from their peak. Illustratively, S&P assesses the United States as of early 2012 at intermediate risk on account of economic imbalances, arguing that the country was still in a correction phase after the credit and real estate boom that peaked in 2007, with the banking system still digesting the fallout from a large but diminishing private sector debt burden, plus legacy losses from the unwinding of the boom. This includes another 5% fall in home prices in 2012, which would make it the 5th straight year of decline. Nonetheless, consumers were continuing to reduce their household debt levels, with private credit having dropped an average of 3.4% annually over the period from 2008 to 2011. The rating agency estimated the U.S. banking system's losses between 2008 and 2011 to have reached $585 billion, with another $120 to $140 billion to come by the end of 2012. From this, it concluded that absent a double-dip recession, the remaining impact on the banking sector over the following 2 to 3 years should be limited. Regarding the USA's external position, S&P sees limited vulnerability that does not influence its score in this category. the depth of the recession was expected to reduce the U.S. current account deficit to 3% of GDP in 2011, down from its peak of 5.1% in 2006. And average net external debt as a percentage of GDP over 2010-2011 had been reasonably contained around 41% versus 38% in 2008. The third and final factor is credit risk in the economy, whose four subfactors you may recall are private sector debt capacity and leverage, lending and underwriting standards, payment culture and rule of law, and sovereign government credit stress. The table appearing now derives the initial credit risk score from various combinations of GDP per capita and private sector credit as a percentage of GDP, with the best positioned countries in the top left cell of the table scoring a 1, and the worst positioned ones in the bottom right cell scoring a 5. As before, a number of adjustments may be required, which we describe next. A 1-notch upward or downward adjustment of the score is required if GDP per capita is considered to be distorted by currency movements, commodity price volatility, or the like. Thus, for example, a significant change in GDP per capita compared with previous years, stemming mainly from a change in the country's exchange rate to the dollar, is considered by S&P to distort the credit risk assessment, since the focus of the analysis is the private sector's debt capacity in local currency terms. Similarly, a significant change in GDP per capita, stemming mainly from highly volatile commodity prices, is deemed to distort the score, especially if GDP per capita is projected to return to prior levels within 2 or 3 years. Another 1-notch adjustment in either direction may be applied if any of the following is true. The household sector of the country, evaluated via indicators such as household debt to GDP, debt service to disposable income, and financial wealth, is significantly stronger or weaker financially than that of countries with the same initial credit score. The corporate sector of a country, evaluated via indicators such as corporate credit trends, corporate bankruptcies, and the level and trend of delinquencies and non-performing loans in the system, is significantly stronger or weaker financially than that of countries with the same initial credit score. The composition of a banking sector's loan book is significantly different from that of banking sectors in countries with the same initial credit score, such as where there is a significantly larger or smaller share of prime mortgages, which are typically low risk, or of construction loans, typically high risk, or the GDP per capita of a country materially overstates or understates the debt capacity of the part of the private sector that typically borrows from banks. For example, in oil-producing economies, the companies generating much of the country's wealth rarely borrow from the banking sector, so that GDP per capita overstates the debt capacity of the borrowers in the banking system. The next subfactor is the banking sector's lending and underwriting standards, which, in S&P's opinion, influence the severity of banking losses resulting from an economic downturn. The table appearing now lists a number of descriptive characteristics that are applied on a best fit basis to determine whether a banking system is at least moderately conservative, relaxed, or aggressive. With the first of these leaving the initial credit risk score unchanged, the second of these giving rise to a one-notch adverse adjustment, and the last to a two-notch adverse adjustment. The characteristics in the table straddle a number of different banking disciplines and include the following: the share of new residential mortgage lending with LTVs above 80%, the average indexed LTV for the residential mortgage portfolio, whether underwriting standards for mortgages are based on multiple factors and include both cash flow requirements and collateral values, the extent of non-prime mortgage lending, concentrations in cyclical or vulnerable sectors, the extent of real estate construction and development lending, the extent of single-name concentrations, the extent of foreign currency lending, coupled with the determination of whether the domestic currency is credibly pegged to the foreign currency of such loans, and finally, the use of securitization and derivatives to shift risks off balance sheet. The next subfactor within the credit risk score is the payment culture and rule of law, also deemed to influence the severity of banking losses following an economic downturn. This is evaluated by assessing creditors' rights and the predictability of the legal framework, including bankruptcy law, creditors' ability to recover collateral, and the resolution time for bankruptcy or foreclosure. The final result of the above analysis is to classify each banking system into one of the following three categories: at least moderately strong, in which case the initial credit score remains unchanged, or weak, in which case a one-notch adverse adjustment in the credit score occurs, or finally very weak, in which case a two-notch adverse adjustment is applied. The column in the middle of the table that has just appeared provides some color on how these terms are used by S&P. You should click pause for a moment while you review its content. The very last subfactor, which adjusts for sovereign government credit stress, can give rise to either a one- or two-notch adverse adjustment in the initial credit score, depending on the severity of the sovereign credit stress and the size of government securities held by the banking sector. S&P does not specify what amount of government securities it has in mind, stating simply that a one-category adjustment is applied when a government's foreign currency long-term rating declines by 3 or more notches within 12 months to below BBB-, while a two-category adjustment is applied when a government's foreign currency long-term rating declines by 3 or more notches within 12 months to below BB-. Illustratively, S&P classifies the United States again in the intermediate risk category with regard to this third risk factor, credit risk in the economy. The rating agency notes that at 160% of GDP in 2011, overall private sector leverage is still high historically, due principally to the corporate sector's failure to deleverage as rapidly as the household sector. The country's lending and underwriting standards have evolved significantly as a result of the crisis and are no longer viewed as a material negative factor in the near to medium term. The average loan-to-value ratio for residential mortgages has declined from 75.5% in 2007 to 71% today, a striking improvement given the diminution in real estate values. But it has risen somewhat from a low of 68.4% at year-end 2010. New lending to non-prime borrowers has collapsed to only 3% in 2011 from 17.4% in 2007. And bank examiner reports confirm that lending and underwriting standards remain stricter than pre-crisis. The U.S. payment culture and rule of law is at least moderately strong and consistent with the intermediate risk classification for this factor overall. We would have expected the U.S. to rank higher in this subcategory, but S&P notes disapprovingly that borrowers in many U.S. households are willing to assume more debt than their counterparts in other countries, and also that while the legal system generally resolves unpaid debt cases efficiently, it leans towards favoring the consumer. On the positive side, S&P comments favorably on lenders' loan monitoring systems and the robustness of data at consumer credit bureaus. Lenders are also perceived to adhere well to collateral rules, the subprime fiasco being an obvious exception that is unlikely to recur, according to S&P. Combining the U.S. very low risk classification for economic resilience with the intermediate risk classification for both economic imbalances and for credit risk in the economy, in accordance with the 10-point approach outlined earlier in this chapter, leads to a score of 3 overall for economic risk. This in turn will be combined in Chapter 3 with the U.S. industry risk score to generate the final BICRA group classification for the U.S. But for now, we come to the end of this Chapter 2.